So what exactly is pension drawdown and how does it work? Well, pension drawdown is very simply the terminology used by the pension industry to describe taking income from your pension in a flexible way. Before the introduction of pension freedom rules in April 2015, flexible pension drawdown simply didn't exist. The government capped how much income you could take from your pension unless you had other income sources. Individuals also often exchange their pension savings for an insurance product called an annuity that would then provide a guaranteed income for life. Now though, you can theoretically access as much or as little of your pension as you want, although there could be some fairly nasty tax consequences if you took the whole lot out in one go. On top of this, annuity rates are now fairly horrendous, so unless there are extenuating circumstances, most people opt to invest their funds instead to achieve a higher growth rate. All of this though means more choice, more responsibility for the consumer, and a greater need to carefully plan your expenditure and how you're going to invest your money. You might also have heard pension drawdown being referred to as flexi access, but what very few people realise is that the vast majority of workplace pension schemes don't provide a flexi access service at all. This means that if you want to access your pension flexibly, in line with your spending needs, you're most likely going to need to change your pension provider to achieve it. It's one of the main reasons why people are required to engage with their pension at retirement, as they're effectively forced to carry out a transfer. Really, it's something you should take advice on well in advance of retirement. You want to ensure that when the day arrives, you have a clear understanding of how much income you need from your assets, how much therefore you need to have invested, and importantly, that you can access your money in the way that you need to. It can make things really challenging if you leave it until the last minute. So how are pension withdrawals taxed? Well, you can take up to 25% of your pension completely tax-free once you reach retirement age. Although it's important to remember that this is limited to 25% of your lifetime allowance, which is normally £1,073,100. You don't have to take the full 25% out in one go, and many individuals will drip their tax-free cash out slowly. This is to benefit from continued growth in the remainder of their pension whilst accessing a portion of their tax-free cash on a regular basis. They'll essentially be making use of something called uncrystallised pension lump sum rules. So only 25% of each withdrawal is paid out tax-free, and the rest of that withdrawal will be subject to tax at their personal rate. So yes, excluding your tax-free cash, all withdrawals taken from your pension are taxed at your marginal income tax rate. So you want to tread carefully if you're going to take a big lump sum out of your pension. If you've already used up your tax-free cash, you could easily be taken into a higher tax band if you draw a significant amount from your pension in a single tax year. It's why most high-quality advisors will work with you to build your assets within multiple tax vehicles alongside your pension, as it can significantly reduce your tax burden in retirement if they do this well. So, pension drawdown is essentially just accessing your money as and when you need to within certain tax rules. Make sure your pension scheme facilitates flexible access drawdown, as you may need to transfer your funds if it doesn't, and carefully consider the tax implications of any withdrawals prior to making them. As always, if you aren't sure, please take some advice, because remember, your money really does matter.